Equity markets saw some recovery in the second quarter of 2020, with global equities in Australian dollar terms up 6.1%. Listed infrastructure lagged during this period, with the FTSE Global Core Infrastructure 50/50 Index down 2%. The fund underperformed the infrastructure sector, being down 3.5%. During the quarter, the sector saw some strong recoveries in the companies that were weakest in the first quarter, such as pipelines, toll roads, and airports. Considering the recovery in markets generally, this was not surprising. The reason for the sector's lag, and indeed our underperformance, was that the regulated utilities, whose earnings in most cases have seen minimal impact from COVID-19, saw virtually no recovery in the second quarter. These companies had performed better than broader equities in the first quarter, but considering the more defensive nature of their earnings and the benefit they should see from lower bond yields, it is surprising to us that many of these companies are now lagging the broader markets for the year, especially in North America. We viewed this as an opportunity to further shift the portfolio towards regulated utilities, and so away from the sectors that are more exposed to COVID-19 and/or a weakening economy. Abbott has a long-standing commitment to responsible investing, which was formalised in 2008 when we became an early signatory to the UN Principles for Responsible Investing. We did want to take the opportunity to briefly outline how environmental, social and governance, or ESG, factors are integrated into our listed infrastructure research, investment process and company engagement. ESG factors are at the forefront of many investors' minds and have equally been a particular area of focus for the investment team over the June quarter. The onset of COVID-19 pandemic, an increasing focus on emissions reductions targets, and the fast-paced uptake of new low-carbon technologies around the world are all sources of ESG risks and opportunities for listed infrastructure. Mirrored off our approach to equity research, our listed infrastructure ESG research is conducted in-house and shared across the investment team, with the additional input and guidance of a newly appointed ESG analyst to provide subject matter expertise. Our investment philosophy is guided by a long-term horizon, and as such, we do not screen out companies on the basis that engagement is the best way of ensuring management is pursuing a sustainable strategy, capitalising on emerging opportunities, and managing ESG risks. As infrastructure companies are providers of essential services with significant community implications, we aim to encourage companies to achieve ESG best practice to the benefit of investors, customers, and the broader society in which they operate. We'd be happy to discuss how we integrate ESG factors into our investment process and company engagement, so please contact us if you'd like further information on this. Notwithstanding the tough start to the year for the infrastructure sector, we remain confident in our strategy of investing in core infrastructure assets that possess high barriers to entry and strong strategic positions. These assets are mostly either regulated, subject to long-term contracts, or have been granted long-dated concessions.